The $100 dream just hit a brick wall. In the last 180 minutes, silver went from about $96 to $89, a full $7 wipeout. And if you're staring at your screen thinking, did I just get robbed? You're not crazy. This was not a normal pullback. This was a liquidity event. Today I'm going to walk you through what just happened in the exact order it happened. 1. The Davos U-Turn that sucked the fear premium out of the market. 2. The CME kill switch effect when margin rules tighten. 3. The institutional wall under $100 that turns buying into a trap. And 4. The part nobody on the chart is telling you, the paper market and the physical market are divorcing in real time. And listen, I'm not telling you to buy or sell. This is education. I'm showing you the plumbing so you don't get emotionally ambushed again. Let's rewind the crash. 3 hours ago, the mood was euphoric. Silver is ripping. $95, $95.50, $95.87, and traders are already talking like $100 is inevitable. Then the candle flips, not slowly, not politely. It drops like someone yanked the floor out. You saw it. Thin air, gap down, trigger after trigger, stops detonating, bids disappearing. It felt rigged because it was not a human moment. It was a machine moment. Here's the blueprint. The 3-hour timeline, so you see the trap. This is how these events usually unfold, and today followed the pattern almost perfectly. Minute 0. Price grinds to the high. Everyone is staring at the round number magnet. The order book gets thin because sellers step back and buyers become aggressive. Minute 15. A headline, a leak, a whisper. It doesn't need to be confirmed. It only needs to be plausible enough that leveraged traders fear being last out. Minute 30. The first wave sells. Then bids vanish. Not because nobody wants silver, but because nobody wants to be the liquidity provider during a stampede. That's the first sign you're in a liquidity event. The market feels like it's skipping prices. Minute 45. Stops trigger. Thousands of sell if it hits this level. Orders turn into market sells. That selling hits the next stop zone, which triggers the next wave. You get a chain reaction where the candle is being driven by preset orders, not fresh thinking. Minute 60. Volatility spikes. Risk managers tighten. That tightness becomes selling. Minute 90. Liquidation phase. The market stops being a debate and becomes a fire drill. The goal becomes the same. Raise cash immediately. Minute 120. Bounce attempt. The buy the dip crowd steps in, but they're swimming against a machine. Dealers hedging options, algorithms leaning on the tape, and traders who must cut positions before the next call. Minute 180. A temporary floor appears, not because the story is solved, but because forced selling finally runs out of ammunition. If you're wondering why dip buyers couldn't catch it, that's why. You cannot outbid forced selling at speed. Now let me show you the math that makes this so brutal. A standard COMEX silver futures contract represents 5,000 ounces. That means every $1 move is roughly $5,000 per contract. So near $96, one contract controls about $480,000 of exposure. You are driving a $500,000 vehicle with a margin deposit. When the exchange increases initial margin, it's not a suggestion. It's a demand for more cash, right now. Here's a simple example. If you're holding 4 contracts and margin rises by $5,000 per contract, you need an extra $20,000 immediately just to stay in the same position. If you don't have it, you sell contracts. Selling contracts is not a choice. It's a requirement. That's why margin changes can create cascading liquidation. Every forced seller becomes the reason the next trader gets forced. Why buy the dip failed? In a flash crash, emotion is a liability. When bids vanish, the dip is not a discount. It's a vacuum. The dip only becomes a real opportunity when liquidity returns, when sellers stop being forced and start being voluntary. So instead of asking, is $89 cheap? Ask, is forced selling finished? The options. Trap under $100, near big strikes like $100, options hedging can create strange flows. Dealers hedge by selling futures into strength as price rises and unwinding hedges as price falls. That can make the round number feel like a ceiling and the breakdown feel like a trap door. Even if you never trade options, you trade in their shadow. What the Davos headline really did. One rumor does not solve geopolitics, but it can reprice fear instantly. Silver has been trading like a headline instrument. That means the premium can be added or removed faster than supply can change. If the market believes the tariff timeline cools, fear compresses. If it believes escalation returns, fear expands. That's why the move looks irrational. It's pricing probability. The two markets, paper versus physical. Paper market answers, what is the marginal price of exposure right now? Physical market answers, what is the marginal cost of delivery and availability? During stress, paper can move violently while physical barely budges. If premiums and delivery tightness remain, the crash is mostly in claims, not in atoms. So while paper screams, check the physical tell. Are local premiums still elevated? Are dealers still quoting long delivery windows? Are large bars still hard to source without negotiation? If those are still tight, the underlying scarcity story is still alive. The 48-hour battle plan, a framework. 1. Watch official exchange updates. Rumor matters less than the notice. 2. Watch recovery speed. Fast reclaim, down shakeout, slow bleed, digestion. 3. Watch Davos headlines. Delay compresses fear premium. Escalation expands it. 4. Watch physical signals, premiums, back orders, large bar availability. 5. Watch your own impulse. If you feel forced to act, the market is probably extracting a mistake. Now let's go back to the chart and see whether this $89 zone becomes a floor or just the next trapdoor. The liquidity vacuum. Why it felt like the price teleported. In normal trading, price moves through levels because there are bids stacked underneath. In a liquidity event, those bids pull back. Nobody wants to catch a falling knife, so the book thins out. Then a big market sell hits, and instead of filling smoothly, it sweeps multiple price levels at once. That's why you see long red candles that look unreal. The market didn't decide to trade there, it got dragged there. This is also why flash crashes feel personal. They're not personal, they're structural. And once the vacuum forms, algorithms make it worse. They detect momentum, join it, and lean on the weakest side of the book. So a move that starts as risk-off selling becomes a mechanical slide. The only cure is time. The moment forced selling slows, liquidity providers step back in and spreads tighten. Reset or top? How you tell the difference. A true top is when price breaks and the story breaks with it. A reset is when leverage breaks, but the underlying drivers keep breathing. So watch the behavior after the crash. If rallies get sold instantly and the market can't reclaim prior support, that's distribution. If price stabilizes, rebuilds a base, and then reattacks the highs, that's a flush and go. This is why professionals don't ask, why did it drop? They ask, what did it force out of the system? And the one thing you do not do in this zone is let the candle bully you into a panic decision. Panic is expensive, and this market is designed to sell you panic at the worst moment. Take a breath, then read the tape. The Davos U-Turn. When fear premium vanishes, silver has turned into a pure play on one thing: trade war fear. When the market believes tariffs are escalating, silver gets bid like a safe haven and an industrial scarcity hedge at the same time. The setup. President Trump is at the World Economic Forum in Davos, with headlines swirling around Greenland and a brutal tariff posture. The threat of extreme tariffs on European goods has been part of the story, and it's been keeping the fear premium alive. So when silver pushed toward $96, a lot of money wasn't buying silver. They were buying fear. Then the whisper hits the room. A leaked report that European leaders are preparing a de-escalation framework, a delay mechanism, a cooling-off proposal, anything that pushes the February 1st deadline back. And markets don't wait for a signed treaty. Markets front-run the rumor. So what happens? The fear premium evaporates. Not over days, over minutes. That's why the first leg down was so violent. Not because fundamentals changed, because the narrative changed. And when the narrative is the trade becomes fragile. The CME kill switch, margin hikes. Now we get to the mechanical part. Most people don't understand this. In the futures market, you don't own silver the way you own a bar. You control exposure through contracts, and those contracts require margin, cash posted to hold your position. When price volatility surges, exchanges can raise margin requirements. That is not a conspiracy. It's risk control. But in a crowded long market, it becomes a match in a dry forest. Here's how the kill switch works. Silver rips higher. Volatility expands. Margin requirements jump. Traders suddenly need more cash to hold the same position. If they can't post it immediately, they must sell. Selling drops price. Lower price triggers stop losses and forced liquidations. That liquidation drops price again, which triggers the next wave. That's the cascade you just watched. Even the people who were right on direction get wiped if they're over-levered, because margin hikes don't care about your thesis. They care about your collateral. So when you hear silver flash crashed, translate it to somebody got forced to sell fast into a market that couldn't absorb it. The $100 institutional wall. Now let's talk about the psychological and institutional barrier, $100. Round numbers are not magic, but they are magnets for orders. Near $100 you get profit taking from longs, options hedging effects, And the big one, parked sell liquidity from institutions. If large players have short exposure, whether it's hedging, market making, or legacy positioning, the worst place for them is above the round number where momentum traders go feral. So what do? They build a wall, sell limits stacked under the number, iceberg orders, algorithmic pressure that makes the tape look heavy. And then, at the moment the market is most confident, they hit it hard enough to start a chain reaction. That doesn't require a secret meeting. It requires incentives and automation. If you were wondering why the drop felt like a tidal wave at 95 and 96, that's what a defended line looks like. And once the wall starts the sell-off, the margin dynamic amplifies it. The great divorce. Paper versus physical. Now here's the part that changes how you interpret this entire event. The price you see on your screen is a paper price. It's the price of futures, derivatives, paper claims. But physical silver trades with premiums, availability constraints, shipping windows, and delivery risk. So you can have a day where paper drops $7 while physical premiums stay stubbornly high. That's not theoretical anymore. That's the divorce. When people say the price is lying, what they really mean is paper can be smashed with liquidity games even when physical remains tight. If you're an industrial buyer, a refiner, or a manufacturer, you don't care about a candle. You care about, can I get 1,000 Oz bars delivered on time, at size, without a surprise? And if the answer is maybe, then physical value holds even when paper panics. So today's crash can coexist with physical scarcity. Both can be true at the same time. The real question, was this the top or a reset? Here's how you think like a professional. A top is a story that breaks and stays broken. A reset is leverage getting flushed while the underlying demand story survives. So we ask, did the crash break the narrative or just the leverage? If Davos truly cools the trade war timeline, the fear premium can stay muted for a while. But if that cooling is temporary or cosmetic, the fear premium returns fast. If CME margins rise again, leverage stays afraid, and rallies become more stair-step than vertical. But if margins stabilize, the market rebuilds. And if the physical market stays tight, then every paper smash becomes a transfer of inventory from emotional hands to patient hands. What I'm watching next, the checklist. 1. The $89-$90 zone. If price can hold and base here, the crash is being absorbed. If it breaks clean and can't reclaim quickly, you're looking at a deeper liquidation. 2. The bounce quality. A healthy reset bounces with aggressive reclaim candles. A dead cat bounce is slow, weak, and keeps getting sold. 3. The $96 high. That's now the crime scene. If silver can take it back, the hit was temporary. If it can't, the wall is still defending. 4. $100. Not because it's magical, because it's where the system gets stressed. Watch how price behaves as it approaches again. Speed, volume, rejection. 5. Physical signals, premiums, back orders, delivery chatter, large bar availability. If those don't cool off, the physical story is still alive even if paper is volatile. How to not get ambushed again. This is the emotional trap. You see a vertical rally and feel late, so you chase. Then the market uses margin mechanics and walls to slam you. Then you sell in disgust, right into the hands of whoever wanted the inventory. So here's the rule. Never confuse price action with permission. When silver is moving like this, the market is not asking for your opinion. It's testing your positioning. If you trade paper, reduce leverage, respect margin risk, and assume the exchange can change the rules overnight. If you stack physical, your timeline is different. Focus on availability, not adrenaline. And either way, stop letting a single candle decide your identity. The story is not over. A flash crash is not a verdict. It's a message. It says, this market is crowded, sensitive, and violently controlled by liquidity. But it also says something else. Silver is important enough that the system has to manage it. So here's my question to you. Was this a natural cooling or an engineered shakeout under $100? Drop one word in the comments. Cooling, if you think Davos changed the trade. Wall, if you think institutions defended the line.